What's up, guys? It is the end of October, end of the month. There could be some shenanigans at the end of the month. There could be some risk off tendencies ahead of the election. Also, a big one with earnings going to be led by Google. Why do I say Google instead of something like AMD or SoFi or PayPal? Google's a $2 trillion market cap. All right. If there's a big move in Google, that's a lot of money moving around. AMD, $250 billion. So different scale. I'm a fan of PayPal. I was buying it for like $55 a share not too long ago. SoFi under 7. I like that one too. But those are little fish compared to something like Google. And we've got what else? We've got Microsoft later in the week as well as Meta as well Wednesday. So what else is going on? Let's get the old head out of the way. Don't sleep on these economic prints as well. PCE on Thursday, as well as the non-farm payrolls and manufacturing. Starting to see the soft landing narrative in the manufacturing and the services sector there. So the no landing or soft landing scenario starting to materialize. What else is going on? Okay, so if you do think the market is getting overvalued, valuations not a great investment thesis in the short term. Over the long run, valuations tend to matter. Utilities been on a ripper this year. Still, the delta as measured by their current forward price to earnings ratio, still undervalued on that basis, but not as undervalued as energy. Energy, which produces some of the most free cash flow of any sector. You could make a case for a lack of, well, an undervaluation. Let's just say that. Tech starting to get heated, but tech, tech usually trades at those types of multiples. And speaking of tech, slowing earnings growth for the Magnificent Seven. We'll see if that plays out this week. We'll see when NVIDIA reports as well. Tesla, their fundamental picture started to look nice, but you can see up here, and it started to trail off just ever so slightly. So let's see if that trend is going to continue. And here's an interesting one. The Magnificent Seven stocks since the all-time high in July. Utilities and real estate leading the way. That's relatively defensive, but utilities have a great fundamental backdrop moving forward because of all the electrical usage. I mean, powering the mines, the data centers, and the AI narrative. All that infrastructural build out is going to require utilities. But real estate, now that rates may be coming down, at least at the short end, starting to see those come back to life. Financials, which don't do well during a bear market. So this is a good thesis for the no landing scenario. And look at that, the Mag 7 starting to trail off ever so slightly, while everything else is coming back into the mix here. Now, the great Wayne Whaley, great follow over on Twitter or X, looking at October 27th to January 27th, 27 years of the last 50 in which trailing 12 months was greater than 10%. Okay, so looking at similar years, basically when markets were strong, how did they perform from October 27th to January 27th? Look at this, 27 times up 24, down 3. Not a huge move, only up 3%, but still, that looks pretty nice. So I would say the bearish case would have to revolve around escalation of war or some type of turmoil with the political outcomes. But here's another one. This is from Mike Zaccardi, another great follow across a variety of social media platforms, but I follow him over on Twitter or X. Equity risk premium. When you see that equities earnings growth being priced similarly to what you could get risk-free from the treasury market, for example, or just from investment grade bonds, you want to get a better risk premium is what this means. Not a great investment thesis in the short term, similar to valuations, but you can see to go up back to like the 05, 07 area when the risk premium was low, and then eventually you saw turmoil as the housing crisis hit. You could make a case maybe we're, in the last 6, 12, 18, 24 months here where we're going to start to see something, but just something to be aware of. The equity risk premium is not great. Now, we've loved gold. We always love gold. But we want to see. So the S&P 500 to gold ratio, when the S&P is outperforming substantially, you can see here, this was the tech bubble, and then gold rose as the S&P fell. This was leading up to the stagflation of the 1970s, where we chopped sideways for about a decade. And Goldman started to call for a decade of sideways action for our equity markets. Maybe the setup is good for gold again. But let's see here. Is the market going to go higher, get a little bit bubbly, or is gold going to make a move? It's been interesting so far because gold has been up, market's been up too. This one is not adjusted for the 5% drop we got just a moment ago as futures opened. But oil, man, oil keeps getting killed. So what eventually happens as gold gets higher, you see a spike in oil. So this means gold going down relative to the price of oil. Okay, this happened in the 70s, happened in the 80s, it's happened recently. Are we going to get another oil shock? If so, that's going to be trouble. So interesting read here. You could make a case that gold is undervalued relative to equities, but that oil, at least historically, gets up this high and eventually starts to make a run. And last but not least, this is from this is from Carson Investments, Carson Investment Research. October 28th, the most bullish day in markets, going back from 1950 to 2023. So take that with a grain of salt and good luck out there this week.